So, very good evening to everybody. Let's start the December month, and obviously today, as Anupam said, the focus is on the markets and the mutual fund side. So, let me start more discussing about the larger perspective, what is prevailing, and fully knowing that last 1 year has been very challenging for Indian equities, and India relatively has underperformed not only the emerging market but also the developed market. So, with that background of underperformance, rupee USD INR pair continues to depreciate, trade related challenges continues to exist, and narrative about India is marginally weak compared to global equities. So with that background, let's understand where we stand exactly in terms of larger macro picture and what is our assessment on that. Okay. So for a couple of months, we have been talking about a mild risk on rally. And even in October also, we reiterated it, that despite the concern which we have in the market, India is in a mild risk on period. And I'm very clearly making a difference, a mild risk on. It is not aggressive risk on what we have seen in the past. Market corrects and then you get back to aggressive risk on cycle and then market touches new high and momentum continues, which is not the current phase, but it is certainly not a risk off period as a lot of people believe, because a lot of people look at the risk on risk of environment more from a price perspective. We look at largely from the macro and the real risk perspective will give you a fairly good perspective how we look at. Now let's understand how we'll navigate in given the turmoils which we're facing not only internally as well as globally. So let's address some of these things. Okay. Now, I'll first briefly talk about the global liquidity condition, how exactly it's going to play out, because in last 5 years seen extraordinary liquidity market globally. So whatever we have seen rally, not only in India, globally, was largely a very liquidity driven market. And let's say understand what we are talking about in current context, why we are saying Q will come back and how Chinese is continues to the new hope of liquidity infusion in right from 2019 or 18 book which we have written. We have said that till 2030-32 you will see various phases of market, and it's not about just one way q is over and qt will continue. You will feel a phase of extreme high QE environment and extreme high QT environment, so both quantitative easing and quantitative tightening. So that's a way it will play out, and how the relevance of global central banks are diluting, because the relevance is deteriorating big time because they're unable to control, and hence we are talking about volatility in terms of their own action. And this has been a talking point for the various global economists, and we have been very early to highlight this is something which we expect are going to play out maybe by 2030-32. We may not talk about central banks, the way central banks play a very important role in today's context. And that is not only valid for India, I'm talking about more from a developed market perspective, and all global central bank, which plays a very vital role in terms of global liquidity. They virtually dictate the globality, and that phase might get over. Okay. Now let's come back to the in terms of numbers. Okay. Now, as I was explaining, we are at the inflection point. Okay. After extraordinary surge in global liquidity, which has been the key reason for driving the financial market, not only in India, globally. And this is the first sign of some amount of slowdown we are seeing. Something, if I have to say, what we witnessed or what we spotted in India in July 2024, we said that macro picture has started deteriorating. The first signs of deterioration was visible for us in that period. And something similarly we are getting now since for the developed market and particularly US market, followed by the European market. And the starting point is US, where we are seeing, the Fed Reserve, the sharp contraction we are seeing out there. If you really look at the even the repo market is also giving you some signs of discomfort. This has been a noise which we have seen in particularly last 1 month. So we are very clearly seeing that tightening phase is over, and now we are, or the Fed will be forced to inject the liquidity and the quantity easing which we are talking about. But lot many market participants believe that it is bit late for the Fed to react. And we have been talking about that Fed has been generally late in their action, and that's the reason US is losing relevance, and Fed in particular, the particularly US Fed is losing relevance because they are not in the way they used to operate today. There's too much political pressure today. If I am not wrong, yesterday we read the article where Trump talking about that he will discuss the way forward in terms of the interest rate scenario before he appoints out of the two gentlemen. So it's a very clear indication that political interference in the Fed is quite visible. And the recent resignation of the current chairman also endorses this thesis. So now what is left is very important to understand what additional measures they will take to infuse the liquidity. Because we have seen that US, particularly Fed liquidity, plays a very important role with the market movements. So it's not we have a perfect correlation. Yes, there's a correlation, but we have seen this correlation typically comes with a 1.5 quarters delay. So that is very important to understand if this is the match which plays out in the US market, and obviously US being the mother of all exchanges, it has its own impact. The only good part is that about China, how 2000 September or October 2024 when they infused good amount of liquidity. Okay, and that's the reason if the Chinese market revert, which means any action happening by the government of the central banks in China has much more impact on the market as compared to US. So this is a statement which I made earlier that the central bank, the Fed itself is losing relevance because their actions are not impacting the market, which is the key objective of central bank. That they can control few things. So which means in today's complex world, China is providing extraordinary liquidity, and one of the key reasons why China stocks has done very well, and is a very important thing. They continue to facilitate that. So this is the one phenomena we have to watch very closely. Other thing is also about the Japanese market, how the meeting is there on 18, 19, what stand Japan take on the interest rate environment. Market is discounting in up to certain extent. We expect the USD JPY pair has a potential to further depreciate from the current level before start inching up. So maybe from 144, 55, it has potential to go to 160, 162. And that's a phase which you're looking at. So which means a short-term up move can happen because of the yen depreciation. But if yen start depreciating, it has going to have some amount of negative impact on the global equity. Now, what is important for us to understand this entire transition which we're talking about from a very liquidity driven economy to real economy. So when we're talking about real economy, is that the macro will play a more important role, and India is actually better poised both in absolute terms and relative terms, irrespective of, and I'm using the word irrespective of USD depreciation, we still in a better position. The next slide I will talk about USD INR as a pair, what is our thesis. Okay, now it is very important for us to focus on the economy more from a macro perspective than just looking from a liquidity perspective. The easy phase of liquidity is about to be over or largely peaked out. Now we are not saying that it will not work and central bank will not support and they will not be very effective. But if every cycle has certain phases, the easy phase of liquidity, that phase is largely getting over, which means global market, particularly US market, has potential to correct and consolidate. Either they have already peaked out or they can potential to correct further from these levels, or they will be very volatile. So it's a combination which not giving us a comfort from a US equity perspective. Now, what is very important to understand is that liquidity was the important factor which everybody was focusing. I think now people will start looking beyond liquidity also because we are in structure tightening phase in that sense, irrespective of the moves that you take. We still believe that we are in structure bull run for interest rate, particularly US interest rate is heading higher in next 5 years perspective. And obviously it has its own impact on the developed market and on the currency front. Maybe emerging market are in a better position, and India within emerging market is still in the better position. So this is a small important background you understand. I'm not getting into more details. but this give you a fairly good perspective what we are looking at into these market. Now let's come back to earlier part. So we are in the end of year, and I just recollected last time also I talked about when we had this call in January 2025, market was correcting and people were slightly worried. Okay. And I distinctly remember that a lot of call people have asked this question, how the year will be ended as compared to 31st December 2024. And if you really look at 31st December, we were at nearly 23,460 levels lower, 500 average. If you take out the closing was 644, 23,006, where we are close to 26,000 crore, 26,000 Nifty, which means nearly 2,500 points higher than December. That's a thesis which played out quite well for us. And people were so worried. I said it will be positive return will be there. But obviously, we understand the portfolio has not delivered that sort of returns. What indices are indicating as compared to frontline indices, portfolio has considerably underperformed because lot many portfolio has mid and small cap portfolio. And within that basket also is not like everything has performed. So it's the index has done very well, but the breadth of the market has been deteriorating on, if I have to say, month on month basis also. Forget quarter, last 3 months we have seen, or 4 months we have seen, four on month it is declining. So this is the small background, but still that in October call I also highlighted that the concern has been very high in India, and despite that concern, we said the macro data which we track, or the lot of high frequency indicator which we talked about, we are slightly more constructive. And hence we talked about that most of the frontline indices will make all-time high either by end of December 2025 or maybe beginning of 2026, so which is like mid-January or so. And this is something generally we don't give targets and levels given the confidence level was so badly shaken. We thought if we give you some perspective that we are heading towards 27,000 plus minus 200, 300 points. It can always happen. And nobody has a God status to give you pinpoint numbers, but it gives you a perspective that the frontline indices, both Nifty as well as Bank Nifty, has potential to make new lifetime high before we assess the entire situation in mid of January 2026, and then we'll take a conscious call for the outlook for 2026. Now let's talk about from a current challenges which your market is facing. Let's address the most important point, USD INR. Okay. Now I just want to take a minute and just to highlight when we wrote our Being Relevant book in 2018 or May 2018, we talked about that USD INR will touch 90 levels, and we are slightly above 90 levels now. Now it is very important as a lot of people patients are getting tested, and we think whether it is a breakout scenario, and a lot of people think it's a breakout scenario. Based on some of the cycle analytics which we do, we still feel that USD INR pair is actually peaking out. So our approach is not towards looking at some sort of breakout and getting some sort of capitulative in our thought process that if rupee is going to become depreciate, what will happen to Indian market? Frankly speaking, it has no perfect correlation. And in fact, for last many years, rupee has been depreciating and market has been rising. So most of the analysts always factor 3 to 5% year-on-year weakness. Okay, so that's the phase we are in. My personal assessment is that it's a deliberate strategy to reduce let the rupee to depreciate further. When RBI governor themselves talks about that we are not going to control or any specific numbers, it's a clear indication that if our trade deal with US is getting delayed, the government does not want. Okay, again, these are implied analysis. It's not something somebody has highlighted to us. So it clearly means that the government doesn't want the export to suffer. So it has allowed rupee to depreciate a bit so that our entrepreneurs or companies get required time to decentralize in terms of just focusing only on large US economy towards more distributed or more countries focus. And that's the reason current government focuses a lot on the bilateral talks, which is going on and which might take 6, 8 months. And that could be a very strategic move to allow rupee to depreciate from time being, so that refuting. But one of the key reason why rupee depreciate, obviously, from the flow perspective, both FPI, MDA flows are on the lower side, very, very weak, despite we have a relatively strong economy. But this is something, one important element of the macro picture is not supporting us. So purely from a demand supply perspective, it has its own pressure on USDI. Now let's talk about the sentiments part. Obviously, sentiments has been negative. People portfolios are bleeding, so it's a psychological pressure that momentum is not getting built. You look at the Gift Nifty was showcasing on Friday evening, 160 points down. Okay, and now finally we close only some 12, 13 points down, which is very clear indication that market open with a weak US background. But on our strength, we have nearly closed flat. Small cap was slightly positive, mid was also flat. So it's a very clear indication that despite very negative consensus or the environment, which is very gloomy right now, market is not willing to fall. Market is giving a very different perspective than what we are looking at. That's the first point. And I always say when people get capitulated, that's the time market tends to rebound. We are not talking about a very sharp rebound, okay, or non-stoppable rebound. That sort of juggernaut we are not looking at. We are very clearly looking at a pullback rally is definitely on the cards. And because the sentiments are so much weak, I will not rule out if the spike is more meaningful. Okay. Now, obviously, good amount of shorts have some of the shorts have definitely covered. It's not as high as what were in October, but still meaningful short exists. And we clearly believe that the recent high, which is made close to 26,300, once this level decisive, broken and sustained, I think people will come forward and cover their short. So again, repeating of the thought process, a new all-time high in Nifty, maybe by December or so, or mid-January is not ruled out. Obviously, Indian underperformance in last 1 year also gives you additional comfort that on relative basis. I was just looking at a lot of macro data yesterday, and we are think that worry is not India. Worry is actually US market. Worry is the developed market. And in fact, if I have to say very unbiased view, emerging market picture looks slightly better in India. Within that emerging market looks very comfortable. Even some of the Chinese market macro data is started actually deteriorating, which also means I always believe that India and China both compete. In last few years, if you look at from 2020, and China suffered, we did well. And last year when China pumped a lot of stimulus sort of thing, and they have done very well, and we have suffered. So, if any impact happens on the China, will be a psychologically more positive news for India. So that's additional data point which is very supporting. Now, obviously, delay in US tariff is affecting sentiments, more sentiment than the actual number because the contribution to the US export is not very meaningful in overall GDP number. Okay, but it has its own sentiment value and it shapes the entrepreneur's confidence. Obviously, any further delay will impact earnings of select industry, not in general. And obviously, with USD INR pair depreciating, it will give them desired support more from a psychological perspective than absolute terms. So we have to be very watchful how it plays out. I'm still not that concerned as compared to what market is endorsing. And obviously, we expect the GST and IT benefits will support second half of 2026. So we are more constructive. Now, if you really look at from a global outlook perspective, typically seasonally December is a bullish month for thing. What, as I said, that the concern is US, good amount of complacency there. Macro picture is deteriorating. US cross-border flows have started deteriorating. And very important data point is that the liquidity is sharply shrinking. Okay. With that background, ability to hold US equity looks slightly difficult. And they all have made their lifetime high again very recently. And we have seen that this time Dow and Russell has performed better than the Nasdaq. And this is a trend which I will talk about in equities also, how new age companies has potential to suffer from now. So very clear indication that hype which was created in the name of AI and ML and some new tech names which has done extremely well. A lot of people talk about hype happening and the bubble is getting created in US. Frankly speaking, the US bubble is a very certain pocket and very small part of the market, where far bigger bubble is out here because none of the Indian new age companies actually make money and there is no visibility for next 5 years also. So the entire thesis is that we should be more concerned about new age company in India than in US because still Nvidia trades still at what 26 times or so. So we are not worried. Worry is complacency which is there, and hence we believe that India has still potential to outperform going forward, both developed market as well emerging market because of sheer outperformance which you have seen. Now, we talked about earlier call about the crude, that crude has potential to fall, correct? And I think that cycle played out quite well. Now we are turning slightly more positive outlook on NYMEX because this basket has actually underperformed the both precious and base metal decisively. We are more constructive on the crude from the current level. That's a very important observation. How it plays out, we have to see. But as of now, it has certainly that it has potential to recover. Whether it will be a very sharp recovery, difficult to say, but that's the one data point which is showcasing. Second thing, and right from July, we talked about that commodities prices, particularly the precious metal commodities price, has potential to correct 15-20%. We have seen sharp correction in between, but they have recovered much earlier than our own expectation. And we were expecting by December they should correct 15 to 20%. This is what we have talked about. They corrected sharply, but they have recovered. Now, the way I'm looking at things, since this medium term cycle that should end by end of December 2025, we will like to review in the month of January our outlook on both precious and silver and gold. And we always, as a house, said we have been saying for last many years the long term outlook of the precious metal is very good and we should have very sizable. We always talk about 15-20% exposure one should have in the precious metal. This we have written. Despite that, in July to December, we said there will be corrective phase. It was a correction, but short-lived correction, and then it has rebounded and silver has made again all-time high. That's the way. Now we don't have very aggressive view from this level, but we review in the month of January. Now let's talk about with this background, let's say understand uh, what changes we have made in our portfolio because last year when uh, stimulus from from China happened and the large cap also corrected significantly, it has definitely impacted our performance because by the time we were moved towards large cap, let's reassess our last over 1.5 years of risk off period till now. I just want to briefly talk about, and then we'll talk about what changes we have made in our portfolio. So we were very early when we saw first signs of risk off phase in July 2024, and we talked about our high frequency indicators are showcasing that easy phase of bull run is getting over and Indian macros started deteriorating. We were very early to talk about, and that's the time a lot of FIs were strategists was upgrading India, and by January 2025 they realized that something got changed. So we were very early to make that call. So those overall approach or the risk of period we identified much earlier. See, in the business of risk, very important to understand that you have to be ahead of the curve. Doing a postmortem analysis with risk never works. And we always say that we are in the business of risk and returns are byproducts. But problem what happens in India, people are so used to certain amounts of returns, absolute return relative to the benchmark. People don't look at the risk adjusted and what risk you're taking. And obviously, some fall is not happening, say it's not or not happen. But what is very important to that, if you are seeing a risk, then you have to assess and accordingly take step. So if you see a risk of what is the strategy, obviously move from liquid to liquid names. We move from high beta to low beta and move from high and mid towards large cap. This is exactly what we did from July 2024 onwards. Come September, October, we have skewed our portfolio towards large cap and we did all those things as a like a normal sensible person. But uh, in the month of September, October, or the fourth quarter of 2024, when China's stimulus happened, a lot of FI-based selling came in the large cap because they typically has large cap, and that has really dented our performance in that particular quarter. And since then, we underperformed that period. And we always talks about, and a risk off period is not very advisable to be very aggressive. We always talk about in risk on period. We always try to generate extra alpha and keep it for difficult time. And as we always talks about, the equity is all about long term, 5, 10 years horizon. So if 10 years is long term, if anybody is looking for 5 years investment horizon, one quarter or few quarters or a year also of underperformance does not make meaningful difference, because you have to look for larger perspective. And this is what exactly what we have done in the past. And obviously, when we look back and we try to analyze why the underperformance came, we obviously spotted that our strategy of identifying the risk of period was right, but the some of the stock selection has not played out very well, and particularly the mid cap stock selection has not has been great, and that we changes we made. Another thing was also last year we didn't participate in the uh, so-called new age company which has performed very well. And last year, when overall economy was doing well, people were chasing new age company because at least there was a growth. And we as a house, when we don't have data, and we do look at a lot of weightage on the cash flow, and that too on the trailing basis, which we look at not on the forward basis, we have not participated. And these are the areas which has done extremely well. Is one of the reason some of the underperformance, particularly in the mid cap space, came because these are largely mid caps names which has done extremely well. That's an important point. And third important aspect was, obviously, you have to understand the type of environment which we are in. When volumes have dried up, impact costs has risen, geopolitical environment was slightly weak, and a lot of turmoil on the currency front, on the trade war issue as well. We thought it's better to lie low, and this is something which we did. Now, as we talked about in last few months, the mild risk on has happened. We have reassessed our portfolio, and obviously, we still maintain that given the global turmoil, our focus is on liquidity is the first priority, safety is second, and third is the return. That's the way we are still operating, but with now we are in still mild risk on. We have made a lot of changes in our portfolio. So basically, what we have done, obviously, our large overall portfolio is towards large cap portfolio, and we have pruned down some of the cyclical which we are holding in our portfolio, and we have large and mid-cap stocks in our portfolio as compared to small cap. So what we have done, obviously, we have restarted the switching very aggressively. We have reduced high beta PSU. We have avoided some of these expensive new age companies. We are still underweight metals and auto. What we did, what not only we have revamped the portfolio, we've increased our exposure toward technology stocks in a big way, because we felt they were in the uh, neglected zone sort of thing. They have underperformed. We were luckily we didn't have any exposure for last many quarters. So the one area which we are very optimistic, and we talked about that September 2025, we expect earning cycle for even for the technology stocks should bottom out. So we have increased exposure. We have increased our exposure to our insurance company in a big way. In between, we have increased our exposure to the NBFC, which we have retained. We have recently reduced our PSU bank exposure. We have added private bank very aggressively. Generally, as a house, we don't, and historically, we don't have very large financial exposure, but this time we are running a very large financial exposure purely based on our data analytics strength. Once. So from a largely perspective, we believe that 80% of the rebalancing exercise in our portfolio is largely over. Another 20% will happen over a period of time, because it is not really advisable that you can take 360-degree switch sort of strategy, but in a phased manner, we have done it. And what is very important for us to understand now, we have started using a bit amount of high frequency analytics also in our portfolio with the launch of, say, this is one additional tool which we have implemented in last 1.5 months. Particularly, we have been adding. So now 30% weightage has started giving to the high frequency and analytic as compared to earlier 10%, and low frequency analytics is now 70%. That's a one big change we have made. We have moved towards in a big way in a blocks market. So we do participate in a block. Given the low, the impact costs in the market still remain high, and volumes have, though it has picked up on relative basis, but is nowhere close to what we have seen in last 3 or 4 and a half years. So that's another strategy we have made bit changes out here. So what effectively it means, so some of the underperformance which we have seen in across our schemes, we have made result changes, and we have seen that last 1 month the performance has been good. Last 3 months has improved significantly. So it's a phase, when it comes back with a lag effect that will also. So the most important aspect is that we have seen the turnaround in the portfolio, and active rebalancing will also play an important role going forward, also in some of the changes which we have made in the portfolio. So we remain very optimistic about what changes which we have done in the portfolio. And I also want to highlight that, yes, it's a mild risk on. We are still not calling a aggressive risk on rally. That is something which you always keep in mind. Given the high volatile background which we have seen in the global market, we still remain constructive on Indian equities from long term, irrespective of the dollar noise or the USD INR pair noise which is there. But what is very important for us to understand that, yes, Indian macro has started improving, courtesy government, some of the steps they have taken, particularly on the consumption side, but still not that everything is now again back to rosy levels, or we are talking about massive capex are started happening. So it's like a slow and steady move which is happening, and that's the reason we are also watching the macro environment and the micro numbers also very closely. We believe that December quarter will be slightly better than the September quarter, and it's very important to see how well the GST impact will play out, whether it's just confined to auto or some of the consumption names or slightly more broad-based. This is exactly what we are trying to see how it shapes up. But we are definitely not in the camp who believes market has potential to fall sharply or correct from these level. We are evaluating things very closely, and we will make relevant changes in our portfolio accordingly. As I said, 80% changes we have already made, and going forward also, it some of the changes which is still pending, which will happen in phased manner as liquidity start building up. So the overall view is slightly constructive for India, irrespective of the noise which we have seen. But as of now, as I said, liquidity is not from a redemption perspective we're talking about, is more from a psychological perspective. Your portfolio is liquid, your ability to rebalance or rotate or switch becomes easy. And that's one of the reasons why we are giving emphasis on the liquidity of the portfolio. We generally don't have exit load in our portfolio. As we the first house to bring this concept, no exit load except 15 days, which we brought later stage, and maybe mid and small is the exemption. And since then, we maintain our portfolio reasonably liquid. So I'll just stop it here. We'll happy to take some of the question answers also.
Thanks, Sandeep. I think you have covered the multiple questions, because maximum questions I have on the performance, but I will collate couple of them, though you have covered it well. Uh, so you have mentioned that mid cap you have a constructive view, and stocks are entering into a favorable zone. So, are you positioning mid caps as a one of the preferred category for anyone who's looking for 3 to 4 years of investment?
See, Anupam, frankly speaking, if anybody has 5 year investment horizon, okay, then mid and small will outperform large cap. The problem which we generally face with most of the investor at the peak of the cycle, I always say, every investor is long term and every investor has a high risk appetite. The real asset test of a risk appetite is a behavior which an analyst or distributor themselves has to analyze how they have behaved in 2008 or 2000 or 2018 or 2020. They will give you a fairly good perspective. Why I'm talking about is that because generally expectation on mid and small is high, but people are not able to hold their position because they don't have investment horizon of that period which they come with the expectation. So if frankly speaking, somebody has 5 years investment horizon, please increase your exposure limit and small. But if you have 2 years, 3 years, or 1.5 years sort of environment, then please focus on the largely the flexi cap type style of portfolios, which gives a money manager or multi-asset type portfolio, because a lot of people don't have that patience, and this is the phenomena which we have seen. In fact, if I go back and analyze and give you very interesting data, so a lot of people who were got associated early with us right from 2020, they have not exited our portfolio because they were 5 years and they're making money. Maximum numbers of inquiry or redemption which we have seen, or some of the calls which we have received, is predominantly the people who came in the 2024. Predominantly, I'm using the word because a lot of people came at the peak of the cycle. I said their risk appetite was very highest, and that was the pain point. So if you, and obviously equity as a house, when we look at equity in asset class, then obviously you should have a slightly long-term horizon. 5 years is an area which you don't have to you should not need this capital. That much is the way long-term capital is about. That's the way you make big money. But the problem, what happens is that at the noise level becomes so meaningful, people do get attracted and then they realize they come for a very shorter needs and deploy money in the mutual fund, some of these schemes. So in the trended phase, obviously they were beneficiary. But when difficult phase come, but that does not mean we are in difficult phase on the economy such. We are in difficult phase of market on relative basis. When I say on relative basis, when the easy phase got over, we are in bull run, decisive bull run. I always say it's a difficult phase of bull run. So, and hence, we have to increase our investment horizon as compared to, and we have to have be very sensible in terms of return expectation. When earlier, if you talk about 10-12%, people are very happy. The benchmark, suddenly the goalpost changed from 35%, 30% sort of thing. And obviously, that was the one pain point where our own expectation was significantly higher than that itself was the biggest issue in the market. So that's the way I would look at it.
Thanks, Sandeep. I think next question is from Avinash and from the Chirag. I think you said you are increasing the private sector exposure and you know changing your exposure into the financial in the big term. What fundamentally has changed in the market that suddenly after a long time you are very positive on this sector?
So two, three things. So if you really look at, um, actually banks, if I have to look at not from 1 year perspective, if you look at 5 year perspective, let's say example, uh, a large leader, HDFC Bank, just to understanding perspective only, not to quote any numbers. Will give you fairly where the stock has delivered. Okay, in last 5 years, somebody is holding for 5 years is not able to make money. When this time when we saw, and we always say we look for opportunity, we were first to sell the HDFC Bank when the merger happened. Now, when obviously when the current level we saw opportunity in the private sector bank, in the public sector bank, we were skewed towards private sector bank, public sector bank. And now when we saw that we have generated 25-30% return, it was making sense towards moving towards private sector bank because banks valuations are still reasonably attractive. As I say, Indian economy is not doing bad. So obviously, if you are positive on an economy, then you have to be positive on the bank. Earlier, as compared to bank, CapEx cycle was giving us better return. As compared to bank, some other sectors were delivering better. Now, CapEx cycle has slowed down, and obviously, this is one area which has not performed up to that extent, and that's the reason we have increased our exposure, and we also increased our exposure a few months back in the NBFC when best of the people have given up. So we still like, and now we have recently added insurance also within the BFI space, particularly life insurance company, because they have also not gone anywhere in last few years, and now uncertainty related to insurance have come down. The tax benefit is there. So obviously they are also traded in the neglected zone. Valuations are attractive. So one of the reasons, and it's all about not about absolute return on relative basis. This sector looks better because other sectors are relatively more expensive and they have not corrected up to that extent.
Thanks, Sandeep. Next question is from Mr. A.B. Senthil. that you have a large cash exposure in the quant business cycle fund. So, do we expect any meltdown in year 2026? That's the first question, and
Nay,
maybe
come up again. Anupam, can you just repeat? I missed
we
out.
we have a large cash positions in the quant business cycle fund. So, do we expect any meltdown in 2026?
So, see, a lot of when you look at the position on the business cycle, basically in last day, if we are in the process of revamping portfolio thing, obviously we have to sell and then buy with a gap of a T plus one or T plus two basis. So we sometimes it happens that that position which you see on the month end portfolio may not be the true representative of the portfolio. And today, if I have to look at our deployment, our cash level will be not more than 3-4% in the business cycle. So generally we maintain 2% odd cash, so it may be marginally higher. So it's much lower than what the, so it means further deployment has happened after the month end.
Thanks, Sandeep. I will just talk about the take a name of a five thematic funds and just tell for the 5 year horizon with the high risk appetite, which are the two funds you feel which is the correct right now. So manufacturing, technology, healthcare, consumption, and BFSI fund. So top two picks and maybe in a two liners a reason for that.
So one thing is that the obviously my first pick will be pharma sector or healthcare sector because A, the overall healthcare index or pharma index has also not underperformed significantly, has also not gone anywhere. And given the clarity which is there on the pharma side, rupee related weakness, I think, and visibility in the US on the generic side. So this is the one area which I still feel has lot of potential, and it is something what we were 20 years back in the IT. I think something similar we say we are if you really ask me, we are leading the pharmaceutical thing, particularly on generic side globally. So the market share in US is significantly large. The one area, irrespective of noise, a lot of people don't buy pharma company because they're generally worried about FD action, and then you say we don't get any relief if stock corrects sharply. With a lot of fear, people don't participate. But I think if somebody has asked me one area where my risk levels, I always look from a risk perspective also, my risk levels are significantly low uh, in the pharmaceutical space, and hence that is the best sector. If you ask me on relative basis, which is the best sector, this is the one sector which is good. Second sector, if you have to ask me, second choice, obviously, in the current environment when capex cycle is speaking has peaked out and manufacturing will suffer a bit, and hence the BFSI on a relative basis also looks slightly better to me. And I said that not only about the banks, so since we are not having a banking fund, we have BFSI fund, and given our strong inclination now towards insurance, NBFC, as well as private sector banks, I think that's another area where I think from the current level we are still very comfortable.
Uh, Thanks, Sandeep. Next question is from Padmanabhan, and little tricky question that you have mentioned that dollar will touch rupees 60. So he is keen to know when it is.
So, Pranav, if you recollect, we always talked about 91st. Okay. Now, obviously, we are there. So, when you do take such a large call, so in 2012, when we talked about this cycle, in 2019, 18, when we written about it, that itself, as people are not able to digest, that rupee can become to these levels. So, now, obviously, when you take such a large call, a few percentages doesn't make, so maybe 90 can become 91 levels or so, 91 half, that is still okay. What is very important to understand that, as I said, whether this is a breakout zone or peaky characteristic. So I'm not willing to believe this is a breakout zone and rupee is going to depreciate sharply after this. Okay. My sense is that it can remain here. It looks like it's a part of a larger strategy which government is playing by keeping rupee weak so that overall export does not get impacted. But since we are student of cycle, I still believe this is the area where it should peak out. So if 90 was the call we have taken, and if you have to even take uh, a slightly few percentage here and there does not make big difference. Nobody can pinpoint exact date or exact numbers. But what is very important, this is the sense which we are getting. So we still maintain that appreciation view, but that view is still 2030-32 levels. Okay, this is what we expect below 60 mark by that period, not on immediate basis.
Thanks, Sandeep. Ayush share the question that we have moved from high beta to low beta in the PSU fund. So, what is the rationale behind that?
So, as you understand that PSUs, the good part about PSU, they're fairly liquid. Entry and exiting in PSU is not a challenging, but some of the high beta names, particularly on the defense side, some of the unique names which were thing, their valuation got stretched significantly. That's the reason I use the word high beta PSU. We are not negative on PSU still, but if you believe that overall market look for safety and liquidity, then I will like to prune down high beta names in our portfolio, and that's the reason specifically we written about high beta, not overall PSUs.
Thanks, Sandeep. Next question is on US markets. When US PE is about 31, and so in what extent it will affect India in case there is a meltdown in the US market or a correction in the US markets?
So India, if I have to look at for last few quarter perspective, the beta as compared to developed market, Indian beta is low, and we have negative correlation with the US market. So obviously, I said in the beginning of the presentation that if a US market corrects and China correct, we will be in a better position. So let's say look at today also when US was down, we opened or so Friday was 160 down, we opened with 130 points down, and finally we recovered nearly flat. So obviously the impact is was the beginning itself, and then we came back, which is a clear indication that US market has not impacted. Even this time when US corrected sharply last month also, there was no impact out there in India. So I'm quite clear that fall in developed market or in China will be good news for India because money, these are the areas or this market has done extremely well. Money can actually shift back to India if these market correct sharply.
Sandeep, maybe briefly, if you can tell us what is the current composition of our equity portfolio towards large, mid, and small, if you can just comment on that. I don't know how to say that, but if you can
So,
explain that.
Anupam, it will be not fair to look at overall portfolio. Now, what you'll do with the small cap. So, small cap itself has a compulsion of 65% large cap, small cap in their portfolio. So, we can say that
Maybe
our
in a flexi cap in that case.
So flexi cap, we can say that we must be having maybe 80% or 82% large cap in our portfolio, 6-7% small cap, and maybe 17 odd percent mid cap sort of thing. That's a broad number if I'm able to recollect right.
Sandeep, are you okay to take one or two SIF questions because there are one or two? So maybe if you're okay
Then
with
let's
that,
let's
then
let's let's focus only on mutual fund SI. We can take it next time separately on SI. We can do
sure,
it because
sure,
this
sure.
time we are dedicating the all the calls related to mutual fund schemes.
Maybe I'll take a one concern, which I keep hearing from people, and maybe if Senthil has sent me this question that is the focus of quant team has moved towards the SIF product. This is the one question he is getting from his investor, and an active fund management is missing. So maybe if you
No,
can
no.
combine
So
and
I'll
yeah,
answer that. This question was asked when we launched back-to-back thematic fund in 2023 also. Okay, is that our focus is lost? No. See, we have to understand that we are manufacturers, okay? And SIP is also a great product. So everybody, based on the needs of particular individual and their investment horizon, they can choose the product, okay? Rather than I will say with the launch of SIF, our system will we will be mutual fund will be beneficiary as I said That SI will be largely based on the high frequency analytics, and we have increased our exposure uh, towards mutual fund product also in the high frequency. So we are beneficiary of that. So see, first of all, let's understand most important thing, what benefit it comes for us. Now, when we are running a traditional long funds, so you never think about shorting. Okay, you are always thinking about investing. You are always thinking about buy on dips. The shorting idea never comes to your head. Now, when you have a SIF and you start looking from a shorting perspective, the best outcome is that when you are able to assess your overall portfolio and suddenly you realize that something is weak, and this is a weak, this candidate is meant more from a shorting perspective, the first thing you will do, you prune down your exposure in your existing mutual fund. That's the one benefit will come. And second thing, since this product is largely based on high frequency analytics, we have increased the components. So I don't see that's a concern. It's a more of a psychological thing when people start looking at. I said the when we launched so many products in the 2023, this question was asked, and when all thematic fund did very well for in that period of May till to July 2024, those questions goes. I think we should not look at the focus area, because see, managing so many schemes could be a task for other houses. We run through technology. It does not make any difference to us whether we have 10 schemes or 15 schemes. These are largely lot of systems comes into play, and we are a very tech driven house. We really improve our efficiency and productivity in a big way. So it does not make any difference. Rather than SI will only help, as I explained you.
Thanks, Sandeep. This is a question from Sumit that precious metal are extended their rally, which is proving the equity investors wrong or being missed out. What strategy will work best regarding equities and precious metals?
See, the precious metal is not like as I said, even we were expecting between July to, we said July to December, we expect 20% correction. I think they corrected 8%, 13%, but the correction was steep and rise was equally sharp. So I think the way we should look at is that because a lot of central bank have purchased gold, and when uncertainty comes into picture, irrespective of any outcome, people tend to park these money. And this has been not only in India in the past, it's a global phenomena which we have seen, and we have seen some amount of shortage of various precious metal. Look at last week, the margins has increased in the comex decisively. So I think the way I will read it, I will not like to link two things. Let's say today, general perception is that rupee becomes weak, Nifty should fall, which has not happened. Okay. Okay. So I don't think one should look at in this way. Yes, geopolitical risks are better explained through investment in gold and silver or precious metal in general, but it should not be just like believe thought of, but this is the way it should happen. I think various circumstances leads to gold in a big way, and a lot of people are surprised this sort of move can happen. In fact, in our book 2019 or 18, we have written that made end 2024, beginning 2025, the unexpected bull run will start in the bullion market, precious metal, particularly in the gold. So I think I would not like to read too much into it, and I don't want to get confused with these things because it's so complex world. It's not very simple to understand the way we want to know these things.
Thanks, Sandeep. Maybe last two questions. Your
Yeah.
views on the gold and silver, and vis-a-vis the, if you can give some highlight of the multi-asset fund.
So as in the presentation, I did mention that we were expecting that gold will correct between July to December. It correct marginally and rallied. Long term, we always have said that we remain very constructive on the gold. If you ask me till 2047 outlook, I think gold will be heading towards 12,000 mark at least. Okay, so if somebody now somebody should not care, keep this number in our head and saying this is the number. This is a very long term perspective which we are talking about. So obviously very constructive. A very, I always say 15-20% of exposure should be there in the precious metal. That's the way I define, and that's the way we like that space. But if you ask me, there also the easy phase, which happened in last 1.5 year, that is over. We will be now becoming going forward both gold and silver in next. If you somebody ask me next 5 year perspective, I think it's going to be extremely volatile because that's the environment which we are living in. And hence, if you are saying that it's going to be month on month, a lot of people expect, no, it will be very, very volatile and people will be slightly worried. And particularly silver becomes more volatile than the gold. So that aspect you have to keep in mind, that it's not going to be very trended, gradual up. Going forward, I expect the volatility in the precious metal also, because global participation has increased. Like when, if you really look at today, Bitcoin, as the global participation keeps on rising, the volatility is bound to be more. And obviously, the liquidity also increases when participation goes up. So, with that background, I'm constructive as far multi-asset is concerned. Yes, it's a very good product for us. So, at appropriate time, we will be increasing our exposure on silver or gold. As I said, I will watch to till end of this month and maybe take a conscious call in the month of January how to look at 2026 onwards gold, because lot of year-end data comes and then we like to take a larger call. Broadly, longer term perspective, very positive. Short-term point of view, I think it should, some sort of trading rally should begin, whether it'll happen now or it'll happen in January. That's a call we have to take. So no aggressive view on gold and silver from the current levels, from a near-term perspective.
Thanks, Sandeep. Last question has a two parts. First, again, what fundamental changes have happened in the IT sector that earlier you have avoided, and why you are looking on it? And last, what message you would like to give to the long-term investor who have, come with our funds in the last 1 year, 1.5 years? So maybe last question, two parts: IT and the
So
message.
it's a good question. Let me explain our thesis. So when we talk about dynamic style money management at Quant, we always said that through a VLRT framework, we combine qualitative, quantitative, and behavior. Okay. When whole world was getting carried away in IT, and this is the best hiding place, rupee depreciation, we talked about ownership related AI fundamental challenges facing industry, and we were negative. Now, as when we saw that the sector is now trading in the neglected zone, people have vomited, people have given up. We have seen a capitulative move. Best of the analysts at the bottom, they have downgraded a cycle. You name the best of the analysts. For me, that's a very good signal when best of the people get sucked into the rally, which is the case right now in the new age company. Best of the money manager, best of the analysts, best of the strategists believe these are the future, and any absurd prices, they are buyers. So this is when you are getting sucked at the peak of the cycle, these things. And similarly, people get capitulated at the bottom of the cycle. And this is, we as a house always try to identify stocks in the extreme inflection point. So IT is the one area which we saw, which was a neglected zone. We participated, and we are very happy. It's not like we are extremely bullish. So it's 20% of the portfolio, is anywhere between 6 to 12% of the portfolio, depending on the scheme to scheme. So it's not like we are very highly skewed, but from a zero exposure, results exposure, we have increased our exposure. That's the first point. Second thing, even somebody has come from, let's say, last 1 year and funds have not performed, market has not performed, people are slightly frustrated and irritated about it. So that the only thing I will say, equity is always money you should park, which you don't need for 5, 10 years perspective. Then you are very patient investor and then you make money. Our assessment is says that if even somebody has come at the peak of the cycle, and I'm using the word peak of the cycle, let's say you have come in September, December 2024, which was the peak of the cycle, or January 2025, even you have 5 or 6 year horizon, let's say 6 year horizon, you will still going to make good amount of money provided you remain invested. The problem starts when you come at the peak of the cycle now, and then you expect their performance should come back immediately, and then you start questioning whether my investment on the scheme was right. So what is very important, you should have very clear vision. Equities is all about few years horizon. If you have 6 year horizon, then only come to the equity market and stall and make. Otherwise, invest largely in the balance advantage fund type structure, or the DAF which we try to build, or the arbitrage fund, or the hybrid fund, or multi-asset is the best product in that case. So I think I'm constructive if somebody has a 6 year horizon, 5 to 6 year horizon. If somebody does not have 5, 6 year horizon, maybe he can shift money to the multi-asset type products.
Yeah, Sandeep. So, Sandeep, I think this was the last question, and I think we can close the call with this.
The only thing I leave a thought process, see what is very important. A lot of people really supported us when we came, and obviously people are slightly tired now. So what is very important, we always highlight is that you have to look at in totality in 5 year perspective. We are still leading the chart. What is important, we have to understand this thesis when we are operating in the past, how we operated and what we operating. Something has changed? No, nothing has changed. Sometimes environment changes. Okay, and we have to rebalance. That's the reason we always say quant is always about dynamic rebalancing and learning from mistake, because we always say that 28% time we are always right, 72% time we get it right. So it's very important to remain invested, and with the thesis that you invested, we are very differentiated house. Our portfolio is really different from other. The way we operate, the way we manage things is very different from our traditional houses. So if you have given extraordinary returns in the time because we manage actively, and sometimes active management is underperforming and passive is doing well. So you can't compare every phase that in past the every phase every quarter you should do. That's not statically is not possible or mathematically is not possible. And hence it's a part of active money management that you like active return. Then we have you have to be slightly patient, and this is exactly what we have done in the past. And this is something similar we'll do in future also. Thanks a lot for listening to us. Okay, chalo. See you guys.